the different types of exits and strategic transactions. The business transaction or exit that we're most familiar with is the 100% sale of a business. At the time of the transaction, 100% of the ownership or equity of the business is transferred to the acquirer in exchange for the consideration, and the seller of the business moves on to the next chapter of life at the same juncture of time. But it's important to be familiar with the various types and structures of exits or sales that are available, because different types of strategic objectives, different types of strategic and life planning for companies and their owners and executives can sometimes make some of these options more appealing or fit more perfectly into those objectives, and therefore it's good to be familiar with these options. So today we'll talk about 6 structures that we often see. And so first of these is the 100% sale of the business. And again, that's 100% equity at closing, oftentimes with ownership transitioning out or tapering down very quickly thereafter. The second would be what we see oftentimes as the 80-20 sale. And so you'll see owners sell 80% of the business, maintain a 20% ownership, and then the private equity firm oftentimes that is going to own the business now is going to own it for another 5 to 7 year period, at which time when they exit again from the business or sell it again to either a larger private equity firm or a strategic acquirer, that final 20% of ownership will be monetized. So for this particular scenario, we'll take the premise that the selling party does not want to be actively involved in the business post-transaction, and so this is effectively a equity rollover is the phrase you'll hear, and more or less an ongoing investment in the company after the first sale. And so you'll oftentimes hear the 2 bites at the apple mantra in these types of transactions. And so the third would be the same 80-20 sale, but with ongoing participation from ownership. And so oftentimes you'll see a seller say, hey, we've grown this company to a great place. We want to de-risk our ownership or monetize or partially liquidate our ownership. However, we want to partner up with a firm, whether it's private equity, strategic, family office, or whatever it may be, to accelerate the growth. And so again, it would optimally end with that second monetization moment upon the next exit, or sometimes it can be a public offering or acquisition or whatever it may be, but in this situation with a more active leadership role in the business. And so then we move towards the fourth of 6 that we're going to talk about today is a minority sale. And so that 80-20 rule is a rule of thumb. Oftentimes you'll see 75-25, you could see 70-30, you could see 90-10, but the structure is effectively the same. And so when we look to the next, we're going to look at a minority sale. And so this would be a 49% sale. And again, I think for the scenario number 4, let's call it just a partial monetization. So in this situation, existing ownership is effectively going to continue running the business the way they have. They're just basically selling 49% of the business to take some chips off the table, is a phrase that you'll often hear. And so oftentimes the investor in this situation, or the private equity group, will take board seats. However, management will be more from an oversight perspective and not from an active involvement in the business. And so the idea here being, you sell 49% of the business and ultimately sell the remaining 51%, oftentimes to the same party, as it's the path of least resistance, if you will, and also the most familiar party with the business. But this is kind of a non-intrusive minority investment. It does require a certain size of business, however, it's an available option. And let's say scenario number 5 is a similar minority investment, however, more from the growth perspective. So similar to what we saw in the 80-20 situation, where the idea was to accelerate growth, that's oftentimes a minority investment as well. And so sometimes it's purely partially monetizing the ownership, and oftentimes you'll see growth equity as kind of the phrasing or the category of this type of investor. And so again, part of it would be monetization, part of it would be deploying capital into the business, but that tends to fall into a somewhat different consideration than those just purely looking to monetize part of ownership. And then we'd say lastly, we look at joint ventures, strategic partnerships, licensing agreements, other things like that, where in these situations, you'll have 2 parties that will not technically merge. No one will actually acquire the other business. However, they will strike a deal either to where one party manufactures something and the other distributes it, where both parties are distributing, however, they're hitting different target audiences, or where both provide complementary services, if you will, whether software, business to business, business to consumer services. But these strategic partnerships are ways in which companies can enhance growth, enhance revenues, while at the same time retaining equity ownership in the business, not disrupting the existing capital structure or compensation structure for the executives. And there are some times where the idea is initially to pursue a minority sale of a business, or even a majority sale of a business, where ultimately a joint venture or strategic partnership becomes the optimal path. And it's interesting because it can sometimes serve as a really great growth for an intermediate perspective. And so sometimes if a company says we'd like to sell within a year, what ultimately happens is a joint venture structure within that year, and then the company ultimately sells 3 years later, but at a much higher revenue mark and implicitly a much higher EBITDA mark and a much higher valuation. And so the point of this video is to just highlight the fact that there are a spectrum of transaction structures depending on the strategic objectives of the executives and the ownership of the business. And so when we work with our clients, it's not one size fits all. We really like to work through this spectrum to see what is the optimal outcome, what is the optimal structure supporting that outcome, and, if you will, reverse engineering the process therefrom. And so again, if you think of the general spectrum as 6 situations, you'd say there's a 100% sale, a majority sale with ongoing involvement, a majority sale with purely an equity rollover investment, a minority sale that is purely for the means of monetizing a part of ownership, a minority sale with the idea of accelerating growth or growth equity, and lastly, a non-sale that is more of a joint venture or strategic partnership. And so with those ideas in mind, you can see that depending on the facts and circumstances of a particular situation, it may be optimal to pursue one or even multiple of these avenues to really extract and boil down to the best possible outcome for a client. So that's the thought for today. Hope the week's going well for everyone. Keep pushing forward. God bless. We'll see everyone next time.